Going, it's Russ here, and at a time when we've seen real estate prices in Canada drop dramatically, more dramatically than any time in recent memory, you might be thinking that those people that bought in at the top, well, they're not in a very good position. But actually, it is the renters, yet again, who are getting screwed in this situation, and I'm gonna tell you why. We're in a situation right now where renters and the sacrifices they're making by paying higher rents are actually being a safety net or a backstop for Canadian real estate prices and the people who own homes. And this kind of isn't on the radar of the Bank of Canada, the organization that's changing interest rates and changing this real estate environment that affects homeowners and renters. Let's listen in on the Deputy Governor of the Bank of Canada, and then I'm going to talk a little bit about what she says before we get really deep into this.
We know that there's a segment of home buyers, particularly those that got into the housing market more recently, and they might have stretched to do so, and they may be sitting in a variable rate mortgage. And for those people, when interest rates go up, there's an immediate effect on their payment, and there's no doubt they're being squeezed. But that is a small segment of the population, not to minimize the effect on that segment of the population, but just to put it in the context of the overall economy.
So Carolyn Rogers here is saying that, well, there actually is one segment of real estate owners that's kind of getting screwed. It's all the people who bought in the past year and have a variable rate mortgage where the interest rate and the payments can go up and down. Now, she also says that there's a lot of people who have fixed payments. You can get a variable rate where the amount you pay every month doesn't change, but the amount that you're actually paying down versus the amount that's interest changes. But she's pointing out here that this is the area of real estate owners that's actually kind of getting screwed. But she doesn't allude to the other huge mess that's going on, and that's exactly what we're going to talk about. Now, you might think that with real estate prices going down, hey, maybe this is a time that people who have been sitting on the sidelines and haven't purchased a home, maybe they'll actually be able to get in at a more reasonable price. But the reality is, and I know it's a little bit counterintuitive, that even though home prices have gone down, affordability for those homes has actually gotten far worse. Let me show you what I'm talking about. Take a look at this. This chart is comparing two different points in time, March 2022 and where we are now, relatively, June 2022. Now, this compares both the average home price in these different cities between these 2 points in time, as well as the average amount of income that you have to make in order to actually qualify for the average 80% mortgage that people get when they're purchasing a home. Now, this applies differently to different places in the country, but we're going to use the example of Toronto just so you can get an idea of the point I'm trying to make here about these numbers. So you can see here that during this first period, that Toronto's average home price was 1.3 million roughly, and that now, a few months later, it's lowered down to $1.2 million. And it sort of shows the different amounts of mortgages that you'd have to get to have like a 20% down payment, and then that amount, the 80% being the mortgage, and the amount of income that you would actually have to make on a yearly basis as a family who's getting this mortgage in order to qualify for that. Now, one key thing that we have to remember here is the difference of interest rates that have actually happened relatively recently. Back in March 2022, the average mortgage rate was 3.14%, and now that average is 5.21. But with the stress test, sort of a test that you have to pass to show that you could actually qualify even if interest rates were higher, well, now people in June 2022 are having to qualify at 7.21%, meaning you have to be able to afford the amount of mortgage that you're getting, even if rates were that high. So as a result, even though prices are down, you're having to have a far higher income to qualify for even a smaller mortgage. So where in January you would have to have a $210,000 income to afford the average Toronto home, now, even though the prices are down to 1.2, you would need a $226,500 income to be able to qualify for the mortgage that you would need to buy the average Toronto home. And this is an increase of $15,000 per year, like of your annual salary in order to qualify, meaning even though the prices are going down, affordability is going down with it. Now, let me ask you a question. When affordability goes down, less people are able to afford to purchase a home, well, what do you think the average person has to do? Well, they have to start renting, right? If you can't afford to buy a home, you have to continue renting like you maybe have been doing for years. That means there's more people who are going to need more rental housing, meaning that due to supply and demand, rental prices are going to start going up dramatically. And this is already starting to show up. Here we have an article from the Financial Post saying nowhere to live, frantic demand for homes to buy shifts to homes to rent. So we see this demand for buyers. Well, now they can't buy it. It's less affordable. Now we need to rent. So now there's an increased demand of rent and less demand to buy. Again, this is going to mean that real estate rental prices go up. And we can see all the data here for many different main cities in Canada, all largely these rent prices going up for the most part, some sort of anomalies here in that data, but we're going to look at the average Canadian data where year over year, I mean, like right now compared to 1 year ago, the average one bedroom is up by 9.07% in terms of how much it costs to rent, and the average two bedroom is up by 11.62%, a national average of $2,110. And this is exactly where people who are renting homes are the backstop or the safety net for people who own homes. For as long as the Bank of Canada continues to raise interest rates, I think that we're going to see more and more flow into demand for rental housing and these rent prices going up more and more. Now, what the rent prices increasing does is it provides a sort of base, a floor that real estate prices can't go below, because at a certain point when prices go down and rent prices go up, it's going to start to make sense for investors, some people who might have money sitting on the sidelines, to actually buy those homes because the rent is going up and that higher rent can now cover their mortgage payment on the property that they're purchasing, meaning that it's eventually, like if you account for insurance and property taxes and all these things, a cash flowing rental property, something where the rent that you get paid pays for your mortgage and all of your expenses and then some. That means it's a good investment from the mind of a real estate investor. So for as long as interest rates stay high, real estate prices will continue to drop, but they can only drop so far before it starts to make sense for investors due to these ratios that we've been talking about, these numbers here, where rent covers more than your mortgage and more than your expenses. And I think that this is unfortunate. We're in a time where there's more and more people not able to afford their primary residence, and through these sort of dynamics, more properties could end up in the hands of landlords who are just making a smart investment given the numbers, but as a result, it's having a negative impact on people who are not yet at that place where they can purchase a property and making it less likely that they'll be able to do so. But here's my prediction for what actually is going to happen over the next 6 months and year. And of course, this isn't financial advice. Now, I think that the Bank of Canada will continue to raise interest rates and we'll see this similar market dynamics playing out in the short term. But at a certain point, I believe that as a result of these interest rate increases, we're going to see less jobs and less employment in Canada. And at a certain point, the government is going to put pressure on the Bank of Canada saying, hey, well, we have poor employment numbers now. We're in this recession. We need you to lower interest rates again. We need you to turn on the money printer. And what happens when they lower interest rates and add more money into the system? Well, oftentimes that leads to a bull market in housing, higher real estate prices. So even though over the short term things look kind of bumpy for homeowners, it definitely seems that as long as these people don't become forced sellers, that it'll be the homeowners, the people that own the real estate, that are going to wind up on top as long as they can survive the short term. But I'm curious what you think about this whole situation. Do you think that my analysis here is spot on, or do you think that I'm missing something? What do you think of the whole rental situation where those prices could sustain the real estate market, preventing it from dropping even further? And what do you think about affordability going down even though real estate prices are dropping? It's certainly a complex situation and I want to hear from you. And also, if you haven't already, check out the links in the description where if you sign up with Wealthsimple to start investing, you can get $50 for free, and that's just free money when you sign up. So you should do that if you haven't already done so. But with all that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.